stocks, they are, well, major averages are mixed right now as we're taking a look at the Dow higher, the S&P 500 and the NASDAQ lower though. As tech drags, disappointing results from Alphabet and AMD certainly weighing on the broader markets here and especially the tech sector. Joining me now, we've got Sam Stovall, who is the CFRA Chief Investment Strategist. Sam, great to have you on the program with us this morning. How should investors be evaluating tech and that trade right now?
Hey, Brad, good to talk to you again. Well, technology is one of the three sectors within the S&P 500 that's trading below its 50-day moving average, but just, slightly. I would tend to make a read of that all of the other sectors are doing fairly well, that what we experienced on Friday and Monday was really just a pretty short-term reset, and we had technology as among the leaders toward the end of the day yesterday. So I think that there's probably going to be a little more softness in the technology space in the near term, but we're maintaining our overweight recommendation on the sector and think that it will be recovering by year end.
You know, Sam, for the kind of 1,000-foot level or perhaps 10,000-foot level, just this kind of blanket question has continued to emerge at the start of the year. Ray Dalio brought it up about a week ago as to whether or not we were starting to see formulation of a bubble and any bubble bursting potentially. And as you mentioned, some of the slippage between that below that 200-day moving average, I tend to wonder, at what point would we be flashing some of those warning signs?
Well, we've been talking about bubbles. When I say we, meaning the marketplace, has been talking about bubbles since last summer. There was a point in which technology was trading at a 78% premium to its 20-year average forward PE ratio. The market itself was trading at more than a 40% premium. That's been trimmed quite a bit. We are looking right now at the S&P at a PE of below 23. Certainly, that is higher than the 10-year average of 19, so that puts the market at a 20% premium. But tech has been coming down and now moving much closer to its more normal PE relative PE range. So, I would tend to say that, yeah, we probably could do a little more digestion of gains in technology, but it's also expected to be one of the strong areas of growth in earnings in the year ahead. And I don't think we're going to be seeing a lot of PE multiple expansion, but if we do get the earnings growth that is projected, then tech could continue to be an outperformer.
What is the earnings bellwether this season that would give further fuel to the fire for tech being that outperformer?
Well, I think the shift has gone from the semiconductor area. Of course, everybody's going to be looking at NVIDIA. But I would tend to say that software is more of an area that could be of concern. I mean, when we started this reporting period, financials in general, banks in particular, were the bellwether. And instead of getting a 35% year-on-year rise, we ended up with a 55% year-on-year gain for diversified banks. So I would tend to say that we still need to see some improvement in the semiconductor and in the software area in order for hopes to remain alive for technology.
As you're laying out your strategy for the rest of the year and even with some of the broader bullish sentiment that continues to try and find new places to invest this year, what are some of the top themes that you think we're going to be set to see play out, not just for the rest of the quarter, but perhaps for the rest of the first half of this year?
Well, I think volatility is going to be part and parcel of any theme that one would be looking at. Traditionally, in year one of the presidential cycle, we see a very large number of, or about a 90% frequency of falling by 5% or more, actually with the average decline being about 17% going back to World War II. Reminding everybody, however, that it only takes about 4 months to get back to break even from a decline decline of up to 20%. I think also that the earnings growth is expected to be a theme because, as I mentioned before, PE multiple expansion is not a likely driver in the market. And if we're expected to see about a 2.5% rise in GDP this year versus 2.8 in 24 and a 2.2% projected for 2026, I think we're going to need also to see some profit margin improvements in order to sustain these higher valuations.
Sam, while we have you here, there was a Schwab study that was out saying about 15% of U.S. stock market investors started investing in 2020. That means that 15% of the investors in the stock market may not have been invested or may not have had any skin in the game when the previous round of tariffs and the previous Trump administration was enacting those tariffs and that tit-for-tat trade war was going on. What is the tariff playbook for those investors that are newer over these past few years?
Well, I think what it reminds investors is that you don't expect the market to go up every year, because if they started in 2020, well, that certainly was a bear market year. Then in 2022, the market was down 19.5% for the full calendar year. So I think these investors have learned quite quickly how volatile markets can be. And as we move into 2025, seeing once again the uncertainty and what kind of driving force that has on investor sentiment and on share prices themselves, but also probably causes them to pay a little more attention to technical analysis to see where the trends are, what the support levels are, and what the likely growth rates could end up being.
Sam, thanks so much for taking the time here with us today. Really appreciate it.
Always a pleasure. Thanks, Brad.
Thanks.